All right, it's spring home buying season, and for anyone out there looking, there's some good news, right? Mortgage rates have dipped back below 6%. But there's always a but, isn't there? A new wrinkle has just appeared on the horizon, the potential for a wider conflict with Iran. And that raises a huge question. What does this actually mean for your wallet? So, will a war with Iran push rates up or bring them down? On the surface, it seems pretty straightforward. But you know what? The answer is a lot more complex and, frankly, more interesting than you might think. To really get it, we've got to look past the scary headlines and dig into how the market really works. You see, for decades, the playbook was super simple. A conflict in the Middle East meant a flight to safety, and that meant lower mortgage rates here at home. But that's not what's happening now. Not at all. It feels like the old rulebook has been tossed right out the window, and we need a new one to figure out what's going on. Okay, so let's start digging. Our first clue is all about how the market is actually reacting to this threat of war with Iran. And believe me, it is not what you'd expect. It's the key to understanding the new rules of the game. Okay, check this out. On the left, you've got the old rule. Think of it as the market's knee-jerk reaction for years. A conflict kicks off in the Middle East, and investors would rush to the perceived safety of U.S. bonds. That flood of money would push bond prices up and yields and mortgage rates down. But now look at the right, the new reality. Traders these days are much more likely to see these events as contained, basically shrugging them off as unlikely to have a major long-term impact on the economy. And this quote right here from a top market analyst, it just hits the nail on the head. Despite all the absolutely wild headlines we've seen this year, the bond market has been surprisingly chill. That tells us something else is going on under the surface, something more powerful than just the day-to-day news cycle. All right, so if these huge geopolitical headlines aren't the main driver, what is? Well, the answer is hidden in the bond market. That's the real engine behind your mortgage rate. So let's pop the hood and see what's really going on. So here's the number everyone's talking about, right? 5.99%. That's the mortgage rate. It's just under 6%, which is great news for homebuyers' monthly payment. But hold on, because there's another number that's actually way more important right now. And that number is 1.93%. This is the mortgage spread. It's like the secret ingredient, the hidden variable that really decides what you pay. It's the whole reason rates have been so stable lately. So what the heck is it? Okay, the easiest way to think about the mortgage spread is like the lender's cut, their profit margin. It's the gap between the wholesale cost of money, which is the 10-year Treasury yield, and the retail price that you, the home buyer, actually pay. So a bigger spread, that means a bigger profit for them and a higher rate for you. And here's the really big story, the reason things feel more stable. That spread is shrinking. It's coming back down to normal after getting totally blown out during the pandemic. Just to put it in perspective, if that spread was still at its 2023 peak, your mortgage rate today would be a whopping 7.17%. That is the real hero of the story right now, and it's a huge win for home buyers. Okay, so we've got two big pieces of the puzzle. The geopolitical stuff isn't rattling the markets like it used to, and that all-important mortgage spread is getting smaller. But what does that actually mean for the housing market, like on the ground? Let's check the data. All right, first thing that jumps out, pending sales are up. That just means more people are signing contracts to buy homes right now than they were this time last year. The market is definitely heating up. So the takeaway? That winter slowdown we saw thanks to some nasty storms looks like it's officially over. Buyer demand is back in positive territory year over year. That is a great sign heading into the spring season. And it doesn't stop there. It actually gets better. Look at mortgage purchase applications. They are on fire. We're talking 7 straight weeks of year-over-year growth. And get this, 4 of those weeks were in the double digits. That is a huge, flashing sign that buyers are jumping back into the market. Yeah, this isn't just a little blip on the radar. What we're seeing is a really consistent trend. It feels more like a wave of demand that's been building for a while. All those buyers who are sitting on the sidelines, they're coming back, and that is absolutely going to have an impact on the market. Okay, so demand is surging. That's clear. But what about the other side of the equation? Supply. How many homes are actually for sale? Well, the good news for buyers is that inventory is up compared to last year. So more choices, maybe a little less of that crazy competition. But, and this is a big but, there's a catch. Look at the rate of inventory growth. It slowed way down. It dropped from 33% year-over-year growth to just 8%. So while there are more homes than last year, that well of new inventory isn't filling up nearly as fast. The market is tightening. And you want proof the market is tightening? Here it is. Fewer sellers are having to slash their asking price compared to this time last year. That's a really solid indicator that sellers are finding buyers who are willing to meet their price. So what this really tells us is that the market seems to be finding its equilibrium, its sweet spot. Demand is firming up. I mean, sure, about a third of sellers are still cutting prices, but the trend is what matters, and that trend is definitely improving. Okay, so let's recap. We've looked at the Iran factor, we've decoded the mortgage spread, and we've checked the real-time health of the housing market. Now, let's put it all together and figure out what you need to be watching this week. And it is going to be a very busy week. Of course, all eyes will be on the Iran situation to see if things escalate or calm down. But honestly, the real main event, the biggest test for the bond market, is going to be the jobs report. We've also got retail sales, ISM reports, and a few Fed speeches to keep things interesting. So if there's one thing you take away from all this, it's this. The jobs report, that one piece of domestic economic data, could have a much bigger, more direct impact on your mortgage rate this week than any headline coming out of the Middle East. It really makes you think, right? In a market that seems to swing on every single headline, maybe the real story, the one that actually matters to your wallet, is hiding right there in the data. The only question is, are you looking in the right place?